What's going on, everyone? So today we have a special guest. We have Mr. Mark Freeman, and we're just going to hop right into it, and we're going to ask questions. Mark Freeman is a friend of Black Lion. He comes by quite often, and he just so happened to come by here today. So we're going to go ahead and jump straight into it. It's not scripted, so let's jump straight into it. So, Mark, if you would introduce yourself, tell the people your name, who you work for, and what's your claim to fame.
My name is Mark Freeman. I'm a mortgage broker. I own my own mortgage company and also insurance or retirement planner, basically. I'm kind of in both fields in the financial side since it all incorporates financial in nature. So basically my claim to fame is, finances kind of basically, but in a different, retirement way of what people need as far as what they're going to have in retirement. And mortgages is part of it because, that retirement picture is that everything is all incorporated into one basically.
Okay.
Yeah, retired military as well too.
Well, tell us about that. We gotta get to know the man.
Yeah, in the military, 26 years in the military over at Army Fort Eustis. My profession was, from communications, commo, to logistics, to equal opportunity advisor.
Okay.
Yeah, to quality assurance. So we, as a first sergeant, master sergeant, we do all kind of sorts of things in the military. So they train us that we can multitask and do a lot of different things, basically.
All right. So what made you get into the finance industry?
It's kind of interesting, really. I was equal opportunity advisor, the isms and all the other stuff of the world. And when I was going to retire, I actually had went to the up in Fort Meade, Maryland, with an interview job for EEO.
Okay.
Yeah, so went up there for
real
that
quick.
job.
EEO is
equal employment opportunity.
Got you. All right.
That's what it is. So went up there for an interview for that. And got up there and during the interview session, they pay you to come up there.
Okay.
They fly you up there. They pay for your hotel and all the other stuff. It's hard to get into the security up there as well. So went for the interview and they kind of had the wrong resume, basically. So the same guy had the same last name. His name was Mark O. Freeman. I'm Mark C. Freeman.
Got you.
So me and the guy was interviewing. I'm telling him about equal opportunity stuff. He's asking me about IT stuff. So
okay.
Kind of like got a puzzle and looking. I'm like, why is he asking me about IT and why is this guy answering questions about EO?
Right.
So I'm like, hey, what?
So you guys are in the same room together?
It's like he was at the desk interviewing me, basically. Right?
Okay.
So he was the interviewer.
Okay.
And I was the interviewee.
Got
coming
you.
for a job.
Okay.
Thinking that I was interviewing for an equal opportunity position, right? So the resume somehow got crossed up. So we was talking. I'm like, okay, he got the right first and last name. What middle name do you have? He got Mark O. I'm like, I'm Mark C. So he said, it's not you. So we kind of ended the interview because we couldn't do anything after that.
Right.
The HR director gave him the wrong resume.
Got you.
So with that, I, left, waited. Everybody came on back. And, when I decided to retire, I got this little catalog and it says, insurance. So I didn't really know about the insurance world, but I embraced it, got my licenses, went and did it. And my job was a benefit coordinator where I help companies with their benefit packages. Because, when you're working for somebody, we all want them benefits and stuff, right? So that's what I did with Colonial Life, where we had knocked on a lot of companies' doors and I was able to help them get benefit packages. So in getting the insurance license, you got your life, you got your health, and you got your annuities. Annuities is more on the financial side. And I didn't really utilize that a lot. So I need to embrace that. So I said, let me start doing the annuities. Went for conferences on that as well, too. And start doing the financial piece of it as well. And there's kind of more to it as well. So I started doing that because that's more on the retirement side as well too. So that was pretty good. As people retire and leave money from 401ks, we can roll that into something like that as well too, to help them make it grow a little bit. And it's safe as well too.
And I promise you we're going to get back to that. Because I definitely want to hear your story. Yes. So how did you get into it? But we're going to come back to annuities.
Okay, got you. Right. So that's how I ended up really in the insurance world. I kind of started that way and been running ever since. And I started with the insurance world. And then another guy said, hey, we got this guy. He doing mortgages too before the market crashed.
So we're talking about 08-ish when the market crashed.
Right.
Okay.
Yeah, definitely. So at that time I was doing insurance and then I got into the mortgage. You can kind of do both. So it was just, the guy who was out of Northern Virginia, which he's still up there. We was doing both insurance and mortgage. You remember the old option arms? Those mortgages was pretty good, but they was mostly for investors.
Right.
So they was sold to everybody. So that's how I kind of got into both insurance and mortgages. And even when the world changed, I stayed into it and just been doing both. And here I am still.
Okay. So we touched on annuities, and I know I looked over there, my guy Royce Can you explain what an annuity is?
Annuity is a form of retirement plan. Like when one get ready to retire, they have, if you're working for a company and you put money aside into like a 401k, with the 401k world, it's more of the equities and the mutual funds and all the other stuff, which we know how those work. It's the roller coaster. They up and then they down. You make a lot, but then a lot of time people want more safe money that's more safe, and they want to be conservative. So what annuity is like those, but a little bit better. With the 401k, you can make a lot, but you can lose a lot. With the annuity, they kind of have a cap. Let's just say if you made 30, but they only going to pay you 25. Because the trade-off is that the guarantee that you don't lose any of your money.
Right.
So if you have a $400,000 and the market crash, you don't lose your initial principal.
Right.
You have fees, but you don't lose your initial principal. So annuities is like safe money that one can, with the 401k world, they ask what keep you up at night. When the market is going crazy, everybody's running to try to do something and they can lose it or whatever, We don't have to worry about that with annuities. Annuities are more the safe money, the more conservative money world is what it is. So if you are investing, you need, based upon your age, you can put some in the equities, and you want to have some safe money in the annuities. So when you lose that much, you know you got this growing as well too.
So annuity, is that a form of insurance?
It's offered through insurance companies, but it's not really insurance. It's a retirement vehicle. Like if you have an individual retirement account, like it's exactly like an individual retirement account, but it grows a lot faster than a traditional IRA that you have in the banks. Is what it is.
Okay. All right. So we're talking annuities. What is something that you see for most retirees that you deal with? And I guess we should break that down, because I know in my time in the military that you have different type of retirees, right? You have your enlisted retirees that really, 9 times out of 10, those tend to be the ones that never really planned for retirement. They didn't think about it. Then you have your officer retirees that they couldn't wait for this day to come because they're taken care of. Not to say that it's mostly enlisted versus officer, but that's usually how it works. Would you say that's fairly?
Yeah. Because being I was enlisted as well too. We were taught just to, hey, we make some money, we come in, because our parents didn't get it. So we didn't really know. So as a enlisted, we come in and we the workers. And since we the workers and the managers and stuff like that, investment wasn't really there. A few people may have it, but the average enlisted don't get that.
Right.
So because we didn't know, I just think about when I first came in, making good money, buying radios, clothes, and shoes and all that as well. I wish
what we thought was good money.
Thought was good money, right? If someone had taught me what I know now, we would have been way ahead of the game though. But because of the disparity between the enlisted and officers, where the officers, they get the financial information, and their other officers friends encourage them to do this stuff as well too, where the enlisted, we just the worker bees. You may get with a good officer and they may help that person out along the way, basically. But the average E7 and under, maybe E6 and under, really does not get that unless somebody's educating them about it, And throughout our training in the military, when we had professional development training, we did mostly on professional stuff. We never did on the financial stuff.
Right.
That would have helped out in that time frame. Now, as the new enlisted today, they do get a little bit of it. So I think their retirement system is a lot better. And reason why I say a lot better, because our old retirement system, you do 20 and then you get retirement for life, right? The new one, they are forcing people to do thrift savings plans, and they matching it, which is a good thing. I've known people that did 10 years, 15 years and put out, they walked away with nothing.
Nothing, right.
Under the new system, that'll never happen, because if they put money in, whether they got kicked out or not, that's still their money.
So the way I looked at it, I didn't like the new retirement system only from the aspect of being long-term and retiring, right? Because I know as an enlisted, I didn't have the foresight of saying, let me put money to the side in this 401, because it's not tangible. I can't do anything with it. So I wouldn't have had to, and youth, you're bulletproof when you're younger, right? So I wouldn't have had the foresight then nor now as a 20-year-old to be like, let me go ahead and put money to the side and they're going to match and that's a good deal. I'd have been like, no, I'm not putting anything to the side. YOLO, you only live once, right? So for me, I know that I don't like the new retirement system for that aspect of it, because unless somebody's teaching you, it doesn't make sense for me.
That's true, but look at it this way. It's not that they have a choice. They have to do it.
See, I didn't know. So maybe that's the piece I was missing. I didn't know that they had to do it.
They have to do it, and
Okay.
they a set amount that they got to do. The more they're going to get matched,
Right.
right? So because they have to do it, because that is their only source of retirement, so they kind of have to do it.
Okay.
So that makes it good, because when someone is forced to do something, they don't have a choice.
Okay.
And if we was forced to do it as well too,
Yeah, it's
it would have
different
helped
story.
us out too, right? Even though we would have fought it, but it would have helped us out. But see, now they're forced to do it. So to me, I think it's a good thing, because if 10 years down the road they choose to get out, they're going to have that money, whether they did any extra or not.
No, that's good. That is great information, because that's something we just talked about that, and that's something that was a blind side for me, because I thought it was a choice, not something that you had to do. So definitely, if you're getting put out, whatever the case is, you didn't make the cut, or you decided to get out. Getting out at 10 was some kind of, and you could take that and roll that over into another vehicle, right?
That is correct, because that's where thrift savings plan, the annuity come in. You can roll it to an annuity because it's qualified money. With the thrift savings plan, since you didn't pay tax on it and you got a tax break, when you roll it over, we encourage the young people not to take the money, because they're going to end up losing a lot of it and then paying tax on a lot of it, and then the penalties as well too. So roll it over, go get them another job, let that continue to grow. That's still there for them, in addition to the Social Security they're going to be paying into as well, right? So if they were smart and didn't, if they don't have the knowledge and the education, they just kind of take it, they're going to lose a lot of that money. But if nowadays with all the education and stuff is out there about finances, hopefully they'll take advantage of it, or somebody can catch them at the right time frame and help them to roll it over.
Right.
It's what needs to really happen.
No, that's powerful information, because I know a lot of people haven't thought about that. So I like to concentrate on the younger ones, because I feel, well, no, let's talk about the older ones that are retired. So I did my 20 years, 20 plus, and it's time for me to retire, and I haven't done anything in ways of put money aside. Matter of fact, my TSP is low, because I didn't really put money into my TSP, or I even took money out of my TSP to buy my brand new F-150. That actually happened. But
Right.
I did these things. So now I retire, and my TSP is exhausted. What do I do now?
Well, glad you brought that up. One of the other things in the financial side, I got my certification in a retirement income certified professional from American College. So I do a lot of retirement planning. I try to reach people 5 more years out, because that's the best time to reach them. If I can sit down with them ahead of time and inventory what they have, build a relationship, then that way they be on the right path. So for the ones who didn't do it, and being that you exhausted your TSP, because if you hadn't exhausted it, there's something that you can actually do to catch up. But to play catch up now, really, one thing that you have going for, if everybody who retired military, they at least have the military retirement, Social Security would come along eventually later on. If they did put anything away, that may be there as well. And if they have any sort of disability, that may help them out as well too. So if you're not military, then you really only have your Social Security, or if you're still working, then you got to start saving, especially if you're 50 something. People always ask me how much. It's not really how much. My question to you is, how much are you going to need to live on when you call retirement? It's my question to them. And if you want that lifestyle, how much are you willing to save to try to make that happen? Because right now, if all you have is Social Security, then that's going to be your retirement, basically.
I think the confusing part for some people, right, when we talk about retirement, right? So all intents and purposes, I'm retired. All intents and purposes, I'm retired from the military, right? But that's not the retirement age that we're talking about. So when we talk about retirement age and retirement planning, what does that look like from a
Retirement planner.
right?
Well, we use the term retirement because we retired from one job, but all you're doing is just transitioning.
Right.
Because if you look at Social Security, they say the retirement age is as early as 62. That's not really the retirement age, but one can retire as early as 62 if they have the financial means to do so, right? So when I sit down with people, we look at, are you ready to retire?
But so in the term of ready to retire, what does that look like to you as a planner? Because when I hear retirement, I hear it interchangeably, right? Especially being military. I'm retired, but I work at such and I'm going to retire from that job. And then does retirement mean that I'm no longer working and I'm no longer drawing income and I'm just out here playing? Or from a retirement planner standpoint?
Well, because that word is used in a way that retirement is not really retirement. I mean, when people hear retirement, they think of somebody that's 70 or 80 and retired. That's not retirement for younger people because you still got a lot of time on your side, right? So military is different because you put some time in and you was started young and you was able to retire young, which is a nice thing to have.
A blessing.
But other people, and when you look at companies, because remember I was telling you before when I started doing employee benefits, they used to have defined contribution plans in companies. A lot of that has gone away now. So the government is kind of looking for ways of trying to bring something back to force people to pay into retirement. That's what they're trying to do, because unless you're working for the federal government or the state government, where they have those defined contribution plans that they kind of, as you get paid, some goes into retirement, right? A lot of the civilian sector don't have it. They have the 401ks that if you choose to contribute to, and if you don't, it's going to affect your retirement. So it all depends on who I'm sitting down with.
Got you.
If you're military and you know that you're not truly ready to just stop doing anything because you know you have that income coming in, but then you have to look at it this way too. If you was making 70 grand while you was in the military, now you're only making 30. So everything is cut in half, but them bills are still there.
Right.
So that person can't truly retire. They just need to go on and transition to some other type of job that's going to make up that other 30%, basically, right? So everybody's different. And again, if that officer or somebody who put the time in the military, and we know that officers, a lot of them don't do 20 years. Because if they're not making their rank, they may have to get out then, right?
Right, on city streets.
But at least they may have some savings, and they still got to go to work as well too, right? So everybody's different. No two people are alike. That's why when I sit down with people, we ask them to, let's do an inventory of what they have and then the bills. When they can do that inventory and they can see what money I'm going to have coming in, because most people, the question that most people ask when it comes to retirement is, what income will I have to be able to pay all my other stuff? That's really the question that they're asking. What income will I be living on? And can I afford to just live on that and not do anything else? And probably no, unless you had some other stuff that you did ahead of time.
Right.
But the average person is no, they cannot. They got to continue going working.
Right.
So if they choose, well, they want to get a job, and most jobs they go into today don't offer any type of retirement plan. If they do, if it's a decent job, they may offer the 401k that they need to participate in as well too. But a lot of time people looking at their paycheck, putting into the 401k, the health insurance and all that stuff. But if you're military, you don't have to worry about that. But if you're not, you got to pay health insurance and all the other stuff, right? So the money is going doing it. They still need to save for it. So I get that question asked all the time. You know, one, what income do you need to live on? Have you inventoried your bills coming in? One of the things I ask people too, if you can take the income that you have and cut it in half, and if you can live on that, then you know you're ready to retire.
So then I guess part of your retirement planning financially is also your expectation, what you're going to do in those years that you're not, quote unquote, working, right? So I guess that's part of it too. So if I know I'm going to downsize and move out of the country, say Colombia, some of these things are my actual, right?
Okay.
But move out of the country, what's my lifestyle going to cost me post-work?
If based upon where you go, if you choose to go out of the country, you know, that money may stretch you a little further, but one thing that you don't have is the health care. So if you get sick in one of them countries, where are you going to go? You're going to have to come back to the U.S. So those things that anybody
are all planning purposes.
Right.
They're for your retirement planning.
They need to look at where they're going to, what Medicare system or what health system is available. The income may last them because the cost of living maybe somewhere overseas may be a little bit lower if you have income coming in. It may help out because, you know, you're not dealing with the cars, the Velcro and all the other stuff when you're overseas, because I've been overseas before and, you know, we didn't have to pay for a lot of those things. So the cost of living for that person, their money could probably stretch a little further. Where in the U.S., you're going to have the cars, the electricity, the water, all the other stuff, and the family and all the other stuff you're going to have. So it all depends on your lifestyle of what one needs to live on, and if you have any debts, all that's going to play into a role of
Right.
when one can call retirement.
Right.
But if they can do it far enough out in advance and see that how much I'm going to need, can I get rid of these bills ahead of time? And it can be done if it's planned right. So we have programs to where there's things that the mortgage is the biggest one and the car is the biggest one, but then there are things in place that one can do 5 or 7 years out to make those things go away. In retirement planning, the resources that are available that people don't really know about is that, one, we talked in one of the podcasts about a mortgage.
Mm-hmm.
It's a all-in-one mortgage, right? That's a retirement vehicle, because when we looking at mortgages, we know that we're paying interest, and we're not really going to pay it off for 30 years. But with the all-in-one loan, the average person have their house paid for in 15 or less years. So if that's paid for, if you're planning for retirement and that's paid for, that's one less thing you got to worry about. And then even with the car, so with the all-in-one, since it's giving you access to equity into your house, you can take that and pay off the car. That's one debt that's gone too, right? So now your money is lasting you a little bit longer because all those debts have been, paid off basically, right? So in retirement planning, it all depends on the tools that one have access to, and if they take advantage of them, they could lead to a nice retirement.
Mm-hmm.
And then not only that, we tell people now, especially business owners, if you can fund your retirement in 2 years or maybe 3 years based upon your age, there's a way that you can fund your retirement in 3 years if you got somebody else matching it for you.
Okay.
People always ask me how much. There is a program to where we utilize insurance product, but let's just say a business owner can do $50,000.
What was all that for?
You got another guess.
What was it?
Double book.
What was it?
It was I don't know.
Yeah.
He said you can call him later.
How am I going? Who am I calling?
Shane, I didn't ask his name. I was trying to figure out.
All right.
Yeah. So we tell people that if they can fund their retirement in 2, maybe 3 years. So, for example, there's a program that if one did, I'm just using a number, 50,000 the first year, 50,000 the second year, and maybe the third year, right? That's all they would have to do, because we have a program to
Now,
work.
real quick, when you say 50,000, this is me cash money throwing 50,000 a year, so 100,000 over the course of 2 years. Is this money that I saved, or is this just money that I'm just
Wherever you got it from.
Okay.
If one had the resources and they had those
Got you.
like a TSP or something like that, or wherever the money, they can, we kind of dual purpose their money for them. Right?
Got you.
Especially
Okay.
business owners. Most business owners have money. If you have a business, you have it in a line of credit, operational money. So we take that operational money and put it to work for them, because with operational money, it's for emergency stuff anyway, right?
Right.
So if it's working for you before you need it, that's not a bad thing, right? Because we do a purpose in the money, right? So if they took the 50 the first year, 50 the second year, if they need to buy equipment or whatever, they can borrow from that, not even deplete their money, and buy the stuff, and it's a tax write-off.
Now, listen, before you get too deep, right? Because this is more on the business side, right? So before we get too deep, because we'll bring you back for a little bit more complicated, right? But I think a lot of the people that are going to look at this are going to be like, man, what happened? And we got too deep too fast, right?
Right.
So just going back to the actual retirement side, when you sit down and you look at somebody's portfolio, or you look at what they've done over the years, what is something that you looked at and said, you know what, you really did a good job. I just need to tweak a couple of things here and there. What does that look like to you?
In inventory, and that's why we sit down and find out what they have and what they've done. Make them write down what they have and what bills they have, right? And from the portfolio that they have, if it's not going to be enough, we can reposition some of the stuff and make it work in their favor. What we would do, we don't have to use all of it. We can just say, hey, let's move this over here. Let's move this over here. With that, what I was telling you earlier, if they have money they can put for 2 years, then it's going to be matched.
Right.
That get them on track for
Right.
retirement. So it all depends on what they did before they decided to retire. If they got the right inventory and they can reposition some stuff, that's what that person can do.
What would, like, if random guy, right, did 20 years, whatever job, right? and they come to you and you look at this stuff and you say, wow, this is what would that inventory look like? So we talking like property, we talking stocks, bonds.
Combination of all that as
Okay.
well too, but then you have to look at what's liquid. So if they've got some retirement from 401k, some TSPs, or some other different stuff that they could cash in quickly. They have some real estate. They don't need a lot of it. A few things would work as well too. Gold, bond, and all that other stuff is not liquid. They will have to sell that. So if they have those things, that person, when I look at their inventory and what debts that they may have, that person could be in a good position. Most people may not have it. So most people that I find is behind. So since they're behind, especially if they're behind in their 50s, it's like it's not a whole lot they can really do unless they decide to buckle down and put more away. So everybody's different that I run across, but if that person who come to me and have their stuff together, it's not a whole lot they have to do. But if they want to do more and leave generational wealth, that person in a position to do that versus somebody who haven't done anything, basically.
Okay. So here's a question that Royce would normally ask, but I'm going to go ahead and ask it, right? And this is probably because I have a daughter and kids. So somebody leaving the household for the first time, leaving mom and dad, right? And they enter into the world with zero. They start off as some zero. What advice would you give somebody leaving the house, embarking on a brand new career as 18, 19, 20, that age group? How would you help them navigate retirement? And do you think that they need a financial planner at that point?
Everyone could use one at any given time, but at 18, they're not in that mindset yet. But if they do have a decent job and no bills, I would encourage them to start saving immediately, because if you start saving when you first start working, doesn't matter what the market does, as long as you're saving money and keep that savings there for later, it'll work out for them.
About how much would you say, like what percent of their income, if possible? Because listen, we've all been young, so we all know the struggle of eating ramen noodle and, saying having crates for furniture.
If they got a halfway decent job, if they can at least, because they have time on their side,
Facts.
so they can start with as little as maybe $100 or $150 if they can
A
budget
month,
that
right.
month, right? And just kind of keep it going and keep it going and keep it going. That eventually will add up. And if they keep that principle going, no matter what they do, they put that away and don't even look at it and just let that sit as a savings, that's working. If they happen to be working for an organization that offers a 401k, take advantage of that anyway, right? Because there may be a match. So they need to find out what the company is offering and take advantage of it. Because when I was doing employee benefits, one of the things that I ran across, and it was young people and everybody, is that everybody's looking at what's coming out of their pocket. They looking, I got to pay bills, I got to eat. But what they don't look at is that they got the iPhones and all the shoes and all the other stuff that they don't mind investing in too, that has nothing to do with retirement. But they'll spend money on that. So if they would not get the latest iPhone and just wait till the time goes on, that's money that they can save. So they have the financial means available today than we had before, that they can kind of just research, and it tells them if you just save something today, because they have a lot of time on their side, that will add up basically. And they ain't have to do a lot, because when you're 18, 19, they can just kind of $100, $150 could work well for them. Keep it going. And it all depends on what they put it in. The old 401ks that we had at the roller coaster, now the terminology tax-free retirement, they can 17 can put $100, $150 into one of those, and it'll do wonders for them down the road later on. As it builds for them, they can do car, house, or whatever, college, a lot of different things. So they don't have to do much as long as they discipline to do like 100, maybe 150, even if they can start with 75.
And let me ask you this: when we're talking about how much, do you think something like an insurance policy would be a good place for a young person to park it? Because I'm assuming the premium is going to be next to nothing, right?
That is true, because it's not just any old insurance. We have these index universal insurance for younger people. It's going to be perfect for them, because it's constantly building equity as well too. We're not worrying about the cost of insurance is low for them because they're younger. So most of it is be going to the investment side. They do have a policy that needs to be paid for, but it's very little cost to them because they're younger, right? So that would be the perfect vehicle, because it's all tax free. Like if they was to do a 401k at work, If they need to borrow money, you got the penalties and all the other stuff. But they were to invest into like a insurance policy, it's all tax free. As it grows, they can borrow the money tax free, and they're not even borrowing their money; they're just borrowing from the insurance. So that'd be a perfect vehicle for them.
Explain 401k.
401k is when you're working for an organization and the company decide to set up a retirement type of account, an individual retirement account. And most companies say they may match up to 6%. So if you're working for your dad and he have a retirement account, normally a 401k, then if you put into it, he will match 3% of it. So that total 6%. Sometimes some companies say we'll match up to 6. So if you were to say, I'm going to put 6% of my money and he's going to put 6%, that's 12%.
Okay.
That's growing. Now, keep in mind, it's invested into the market of the equities and all the other stuff with a whole lot of other pot of monies. So it's steadily growing. But when that market has its downside, then that money is affected by it. You could lose it, but you're still young. You got time on your side. So that's what a 401k is that companies normally offer that. And it's a tax-free. So even if you're making like $30,000 and you putting 6%, that 6% is not taxed.
Okay.
So because you're not paying tax on it, that's money that's for later on as well too. So that's what normally what you find with companies. They do some sort of 401k or 403b or something like that. But the key is that if they matching it, you want to take free money that they're giving you, basically.
So we know young folks typically don't have the wherewithal. Well, I wouldn't even say young folks. Most people in certain demographics don't have the wherewithal about finances and money. And I know that I learned later what a great vehicle something like insurance is. You talk about insurance as a way to invest.
That the Index Universal and Whole Life, they both are good vehicles. The Whole Life will basically give 3 to 5% on an average of dividends, where the Index Universal, it utilizes the stock market, the S&P, the NASDAQ, and it utilizes those markets, right? It kind of participate with them. It doesn't directly invest in it, but it participate with them, right? So if one is putting money in there, those tend to average between 5 to 7 to 8% on an annual basis. So by putting money in there and it's compounding, and a lot of times when you put it in there monthly, it takes a little while to build. But if you can do an annual or a lump sum, it's a lot better. So the insurance is the new way for investment because it's all tax-free retirement. Basically, if you do it enough and if you overfund it, that's where the investment side is coming in at as well. And you're able to borrow from it. So if one had a 401k and they had $50,000 in it and you borrowed from it, it depletes that plus the taxes and the penalty. Where if one had $50,000 in an insurance that's cash built up and you borrow from it, you're not borrowing from the $50,000 of cash, you're borrowing from the policy. So that $50,000 is still there.
Right.
So you're not even losing, you're just able to borrow. So if I had a $200,000 policy and I borrowed, if I had $50,000 and I borrowed 10, and if I happen to pass away, they'll subtract it from the death side. So my family would get, instead of getting 200, they get 190.
Right.
Basically, but it's a great investment vehicle if it's done properly, if it's funded properly.
Also something else to get into if you're younger and have time.
If you're younger and have time, and if you have a business and you have the financial means, that's why I was going to go back to that other thing, is that it is an Index Universal. What the company did differently than the most traditional Index Universal, you funding, right? But again, just like a job, if you're working for a company and somebody's matching it, there is an Index Universal that give you the match now.
Okay.
Yeah, so if one, that's why I say you only have to fund it for 2-3 years. One can do 50-50, they're going to do 50-50. So imagine this 130. And they did 50 the first year, 50 the second year. And then this every year 50 is coming. This is the policy, whether you put another dime into it or not.
Yeah.
That's going to be, and that's compounding.
Right.
So not only is it going to give you operational money, it's going to give you a legacy and all that as well too. So that's what the insurance policies are allowed to, because those are unique. Rule 7702 says investment grade life insurance, you don't have to die to use. Because it's college funding, it's emergency money, it's a retirement money. If you happen to die too soon, the money's there for generational wealth too. So that's why the insurance now, people are paying attention to those now, because it's a great investment vehicle as well that does all 4 of those things at one time. So if a young person participated in one of those, and maybe 30 now, maybe 40, that's 10 years they participate in. If they funded it properly, and if they ready to buy a house now, they can just borrow the 10% or 3% from there to pay for it. Or if it's they're 40 now and they happen to have kids along the way, the kids ready to go to college, they just borrow from the policy to pay for the kids' college. So those insurance policies have a very uniqueness of those if you fund them properly, if you get them to them early enough. It's not just a regular somebody you're going to die to use. When we say insurance, most people think somebody's dying.
Die. Like either car insurance, I got to get in an accident, or I got to die.
Right.
Yeah.
But these have uniqueness to them. It's all those, emergency, college, retirement, if you happen to die too soon, operational. So it has a lot of uses to it, basically, what it is.
All right. So I know this is another one for the younger people. And if I had an opportunity to go out there and buy a car and put have a car payment, or buy what we used to call a hoopty or a beater and save the rest, which would you recommend and why?
I would get a hoopty or something that's dependable, that's going to get me for A, B, C, and D, and then just kind of invest the rest until I build up enough and then get a car later.
Now, for the older ones, because this is where having a Mark Freeman makes sense, right? I was talking to somebody the other day, and they were like, hey, I have all this money and this equity built up in my house, but I want to do insert whatever. And I was like, well, how much equity do you have? And they were like, well, I'm thinking about buying the brand new BMW, this, that, and the third. And they had over $300,000 of equity and wanted to go out there and buy this car. And I was like, well, you could. And I'm going to let you finish that one.
You could if you have the right mortgage product.
Right.
Because then we're going to go back to the all-in-one loan.
Right. So that's why I said, go ahead, insert your piece.
So with the all-in-one loan, again, because we are so accustomed to the 30-year mortgage that's closed in that you don't have access to anymore. So many people rush to pay theirs off and then it's closed. In equity, they think that it's theirs. In theory, it's not, because you got to go ask somebody for it. And because you got to go to the bank and say, hey, I need $30,000 or $40,000 because I want to buy a car. Yeah, they'd give it to you, but now you got another payment, right? So that's the close-in mortgage that we know of. And because we are so rate-driven, that I always ask people, which would you take, a 3% for 30 years or 8% for 10 years? Which would you take?
Me, 3%.
You would take the 3 for 30 versus the 8 for 10? It's not the right way.
Well, there it is. See, that's why we got a Mark Freeman.
Yeah. And because when you look at only with a mortgage do we close our eyes and say, I'm gonna borrow $200,000 but pay you back $900. Only with a mortgage because it's closed in.
You're right.
Where if at 8% for 10 years, I'm gonna pay you less interest. It may be 8%, but I'm gonna pay you less interest.
Right.
And then too, with the right type of mortgage, with the mortgage that we know today, everything go to interest first. Interest. With the new 21st century mortgage, everything go to principal first. Principal. And there's no escrow. And they give you a checkbook and a Visa. They combine checking and mortgage into one, to where you have access to 80% of your equity. So that same person with the $300,000 of equity, if he had that mortgage, he have a checkbook and a Visa card. He can just go write a check, pay the car off, and do that. Because I did that as well, because I have the all-in-one, right? So basically, I refinanced into it. I think I owed 80 on my house. It was worth 220 or something like that. So it paid that off, and I had access to 80%, which was a difference, right? So I had that available access to equity. Don't have to ask anybody because I got a check.
That's mine.
Right.
Yeah.
Now the old way, you got to go to the bank and ask somebody. I don't have to ask anybody anymore. So I was educating people that they need to get into that, right? So that same person who wanted to buy that car, because I did it, I financed it. And the only reason I financed it because they wouldn't give me the incentives. So you want the incentive, they want you to finance it because finance is going to make them money over the long time and all that other stuff, right? So I did and finance it. So when the payment came due, I wrote a little check, paid it off. I don't have a car payment now, right? My mortgage was maybe $700. It's still $700. So I'm just using the equity because that much didn't increase it that much, right?
Right.
But because everything going to principal first, it's still being paid down a lot faster, and that mortgage will be paid for in maybe 2 or 3 years. So income driven.
So now to qualify for that, because I think that's the part where people right now, somebody's watching is like, I'm jumping on that right now today, but there's qualifiers for that. What's the qualifiers?
700 credit score. Debt to income no higher than 43%, because when you get a mortgage, it's like 43, 55 or whatever. This right here is a conventional loan, so they don't want you to have no 43% debt to income ratio, and you need to have at least 10% in reserve.
Okay.
As long as it's 43 and under, you need 10%.
When you say 10% in reserve, are we talking about, could it be part of the equity of the house,
No.
the 10%? So this
No.
is 10% liquid.
Right, yeah.
Okay.
Liquid or non-liquid, and I'm going to show you why.
Okay.
So if it's 43% or under, you only need 10%. If it's over that, you need 15%. What they mean by that, if retirement account or in the bank, if I owe 200 on my mortgage, as long as I got 20,000 in a retirement account or in a bank, that's that 10% that I need, or 15%, right? So it can be in either one of those two sources.
Or a combination? Can it be a combination? Okay.
Doesn't have to be liquid. It could be either or.
Okay.
They just want to see that you got at least emergency money in the event that
case.
something happened.
Right.
You don't have to ever use it. It's just showing them that you're savvy enough to have those three things. So 700 credit score, debt to income 43%, and then the reserves, and the income to ability to pay back. So they're gonna still measure it with taxes and insurance, but as long as your debt to income falls within that number, that's a good one to have. And now it's giving you access to equity, and you don't ever have to ask anybody because it combines checking and mortgage into one, like they do overseas, basically, right? Overseas, when you have a checking account of $50,000 in it, and I got a mortgage of $150, because I have 50 in their account, they just let it offset. It just only charge me interest on 100, which the U.S. would do that, but they would never make any money.
Right.
So that 21st century mortgage is the one should strive for, because it's going to give them that financial freedom to pay off all kind of other debts and stuff as well too.
So if I'm a brand new homeowner, I got a couple questions there. If I'm a brand new homeowner, right, can I qualify for this walking in?
Yes, you can.
In the same deal?
You still have to put 20% down.
Okay.
Now you're not going to have the equity, but at least that mortgage will be paid for a lot faster because
Right, because we're taking
income-driven.
we're taking our direct deposit and we're putting it into our mortgage.
That is correct. And
Right.
the mortgage, what it does is checking in mortgage, and what it encourages you to do is, we have money sitting dormant in the bank, Langley, First Advantage, or whatever bank. We may have 20,000 or whatever sitting there just in case of emergency. We ain't using it, but it's just sitting over earning what, 0.2%. So what if I owed 100,000 on this all in one, and I moved that 20 into the line of credit? Now I'm only paying interest on 80. But if I need it, I can write a check and go back and get it, just like it's sitting in the bank. So we put it to work for you.
Right.
You got your regular payments going in, and anything else that you put in there is going towards the principal. But if I need it, I got a checkbook or a Visa card to just kind of go back and get it. So you actually letting it work for you.
Exactly.
And that's what it's doing. So that's why the interest rate don't matter. It's mostly income driven. So you can have a $500,000 house and you have a $500,000 income. So that person can, 15 or less years is what I've seen people pay it off, because it's not rate driven, it's income driven.
Right.
Is what it is. And it has to be used properly. That's why it's only offered to those categories of people. Because if you have access to equity, you just spend and spend and spend, and then it don't work for you as well. It's about managing and using and leveraging and all the other stuff is what it's
So
about.
there's a certain level of financial discipline.
It is, but most people who's in that category have that anyway.
Right.
Because if they got the 700 score, that means that they managing the debts properly. They got the debt to income, for what they mean that they're not overexerting their income, and they got reserve money. So that person already doing it anyway. It's just now, if you're going to have a mortgage company that's going to allow everything to go to principal first, so that way when the retirement do come, the mortgage is paid for. But if I have access to 80% equity, I can just write a check and go do what I want to do anyway, right? So again, that's retirement planning. Having the right tools helps out as you go into retirement when you have the things in place early on, basically.
Now let me ask you this: so I don't have a 700 credit score, or I don't qualify for said loan. Would you suggest a HELOC in that home equity line of credit?
You can do it with a HELOC, but it's not. It works the same, but with a HELOC, they're only going to give you so much, and you just got to manage it properly.
Right.
So you can do it that way. But what I would say is that find out what's causing your score to be under that, and get your scores to that 700, because it's probably just utilization.
Because ideally we want this.
Yes.
Right. So, and I guess I'm talking for the ones who. A commercial just ran into my head. I need cash now, right?
Right.
I need my cash. I need it now for whatever reason, whether it's medical, college, what have you, right? And I don't have the time to play with trying to get qualified for that and go through the process. Would a HELOC be a great second option, or is there something else besides a home equity line of credit?
Well, if you look at the average HELOC, the banks want 700 credit score anyway.
Okay.
So which means that you're still stuck with a 700.
So no
credit
matter
score.
what, so we're in or about the
Because the
same.
banks are very tricky on the HELOCs. You may find one that do it with less, but not very rarely.
Right.
So you still going to need that 700 credit score.
Right.
So it would behoove you to probably find out what's causing my score not to be up that way. Maybe some utilization or something like that as well. Maybe get the utilization down, and then when it gets up right now, you kind of meet the guidelines and everything.
Makes sense. You had a question? So I saw you grab the mic a couple of times. All right. So this is how I know if my younger generation is finding this. Like, you see what he's doing? He's like, man, how do I make money though? Right? So and if we had to say to the younger generation to really get them fired up, right? What are some ways that they could see the money working for them at a younger age? Because here's what I noticed, right? When we get older, we are more in tune with our financial health.
Right.
When we're younger, the only thing we see is what's it do for me today?
Right.
So what do you have, if anything?
Well, that generation is kind of tricky because that's the Gen X's, millennials and Gen X and everybody, because one, saving is not in their mindset right now unless they come from a family history that show them how to do that. Saving is not there. But if they were to listen and they see that tomorrow will come, to start putting away early on, because I know that they still got the things that they want to do.
The iPads, the iPhones, the subscriptions to God knows what, right?
You know, they see that the parents and everybody have these things, and they want them the microwave. You put it in the microwave, and it's
want it
instantly
now.
done, right?
Yeah.
You know, and it just don't work that way,
Right.
So it's a building, and most of the young people retirement is going to be their parents when they pass away. That's generation that will pass on to them is what we see happening if the parents have it, you know. So if one can listen and do that, and if they follow the advice, start putting away early on, maybe finding a decent, go get certified in some type of certification, because that's going to pay some decent money. Maybe lead to your own business or something like that as well. It will come, but it's going to take time, and they do have time on their side. So the things going to be out there, the iPads, because they're going to need those things to work off of, because those things are very effective now. But do the research on some of the IULs and the other things that are available, but get the skill set and at least try to put 10, 20% away. I mean, the more, the better.
So you're saying, and the big takeaway from what I just heard, it's not a shortcut.
It's not a shortcut. It's no way. I mean, it's only a shortcut if they rely on somebody else.
Right.
And they get it instantly because somebody passed away.
Right.
Any other thing is going to take time.
Okay.
You know, time, and if they just discipline themselves and put it away, it will happen. But this ain't going to happen overnight.
And I think what happens is when we're younger, we have friends that are doing all these things, and we're trying to do the things that our friends are doing. We're going to the club. So I broke down the club cost to somebody not too long ago and realized going to the club was way more expensive than just going traveling.
It was.
Right?
It was.
Going to the club, and it doesn't, because you got to buy the outfit, the drinks, the card, everything just to go to the club. And you can't wear the same outfit twice in a row.
It all depends on who you are.
Right. So it costs a lot to party, right?
It does.
Where you can build that memory off of traveling. But I'm saying all that to get to the point that it seems like as we're younger, we're influenced by the times and what's happening around us. And we see somebody who we assume,
Right.
especially with social media, we assume is making all this money, and they're out there showing off, and we think we have to keep up with them. And, you know, to impress some young lady, especially if you're a male, to impress some young lady, you got to go out there. You have to have the car. You have to have the place to stay. You have to do all these things, when in actuality, you should be setting yourself up for the future. So I can see how it's hard.
Right, it is. You know, all the influences and all the other stuff. But if they follow that person, they'll see that person's not doing as well as they thought they was doing. It's just a facade.
Right.
That's what it is. So maybe they renting a car, borrowing somebody's car. So it's not always that way. So I wouldn't worry about the Joneses, because, you know, if you're doing what you got to do, just start putting away. Because, I mean, it's proven that if you do these things, it will happen. It's just not going to be an instant thing.
Not overnight.
Not overnight. I mean, you can still do those things, but as long as I'm putting something away for tomorrow, I can budget on the other things that I need.
Budget and plan, because on the others, because you could budget but under budget for a lifestyle. Right. So I get that.
Yeah, you know, and like I say, you got decent cars out here today. You don't have to have the latest name. Just give me something that's not going to break down. It's going to get me from A, B, C, D, E, F, and G on a regular basis. You know, that's all you really need.
And here's the
right
fun
now.
part, right? If you're properly saving and you're doing your money properly, you have your car. And if you need that special car, go rent it for the weekend.
That is right. You know, because you got the maintenance that go along with the nice cars too, as well. Too. You got the maintenance and all the other stuff that's going to cost you when.
Oh, listen, everybody wanted a Cadillac until they get Cadillac maintenance.
When you go to that shop and they charge you $300 an hour, like, whoa, really? Let me get this and this. You know,
right. You know, I see a lot of younger folks driving the BMWs, right? But then after a while, you start seeing the maintenance on the car. You're like, you didn't realize the maintenance on that BMW was going to be the maintenance on the BMW.
You didn't realize that one of them tires cost $300. Yeah,
that's the low side.
Yeah, you know. So and you know, it's just life. We all want that. You know, it is what it is. But it's like we didn't have the research. We was
No.
But the research is here now. It's available. So they have the knowledge. They can look at and do things. It's there for them. Do they choose to follow the path? You know, like you say, you can take somebody to you can take a horse to the water. You can't make them drink it. All you can do is show them the way, and hopefully they'll follow it.
Okay, so before.
Nah, yeah, I have one. What budget rule for like younger generation would you want them to follow, or what would you recommend them to follow, so they can continue to build their wealth at the same time? You know,
budgeting. Well, if you're staying with your parents, you don't really have bills. But if you stand with somebody else, you have bills. So it all depends on who that person is. If they got their own place, they're going to be more disciplined to try to say, because they know they got bills coming anyway, right? But if you're staying with your parents, take advantage of it. Just put money away and put money away and put money away as much as possible, because you can still party because you don't have the mortgage, the this and all the other stuff. Put as much as possible today, so when that time do come that you're on your own, you have the money basically.
And I think part of that too is be smart when you do finally move out, right? So if you have a few friends that are responsible, let's go in together. So let's crowdfund this thing as opposed to living by myself, right? Because I think there's a pride in there where I want to live by myself.
Right. Until reality set in.
Right. But now you're responsible for 100% of 100% of everything.
Everything, you know. And like I say, be a leader. Don't be the follower. If you're the leader, you know, a good leader, not somebody that's going to be arrogant, but be a good leader and understand that people who's following you, if they're not feeling, you can let the friends go. Just know when to let somebody go, because if they're not seeing the same path with you, if you want to see a light down the road, you're going to do the things that the other one's not doing, and they're going to talk about you, but who cares? You know, back in the days, sticks and stones when they broke my bones, you know, let them say what they got to say, because that means that they're jealous of you. So be you, be an individual, be you, be that leader. You know, who cares what they say, because you just do your thing, do your work, save some money, do what you got to do, because eventually they're going to start coming to you. Can I borrow some money? They're going to do that, you know. So be that person and help them too as well, you know, to be that, you know, hey, this is what we want to do, you know, because they may not know either. They may not have the guidance either. So be willing to kind of educate them as well too. If they don't want to listen, you know, it's time you can cut somebody go. You know, hey, friends come every day basically, and who you call a friend is not necessarily a friend. It may be acquaintances, but they're not friends. A friend is somebody going to lead you in the right direction and is going to do right by you as well too.
So here's to kind of transition, because I want you back. So I want to transition into a bit more investing. I know we talked about different investor vehicles, right? So I'm a brand new investor. I got a couple dollars. I'm brand new. What are some techniques financially, and what products are available to me financially? And I'm trying to lead you down, of course, to one specifically. Right. However, what would you suggest?
If that person is working and the company offers some type of retirement, take advantage of that. If that person is working.
Excuse me, let me be clear, right? I want to invest in real estate.
You can do, well, real estate is hard because, you know, it ain't cut out as you think it is, right? You know, because for investment in real estate, you're going to need at least 20%, have the experience and all the other stuff. So if you have that, you know, believe it or not, I have investors that are investing in real estate, which they can do both. What I find for the people that are investing in real estate is that they put the 20% down, which could be 30, 40, 50, 60, 70, or 80,000 based upon the size of the property. What I find is that they take the 80, they put down for their 20%. They got a mortgage. The mortgage may be $1,500 and they're only collecting $2,000. $500 is not income to me. So you took $80,000, you're only getting $500 because you got a mortgage. And if you're lucky enough to find a property that has very low a thing and you buy it for $50,000 and you fix it up and you sell it more, that's one thing. If you kind of flipping it, then that's one thing. But if you rent it out, that's not really good income at $500. Or again, going back to that 80 and funny, you can do both. So if one had that kind of capabilities and it can do two things, then while that's growing, it can borrow from it and buy real estate while both things are working at the same time. So if we're talking about real estate only, if you try to fix and flip and get the money, then that would be the way I would say. But to buy and hold, you may only need one or two. But when you got a mortgage payment that's 15 and you only getting 2,000, and you're gonna have to save money for fix up, it just, I don't really see it that way. But if you want to buy it, fix it, and flip it, and then keep doing it, then maybe that would be the way. But then you're gonna still need the investment capital to do the fix up,
Right.
Because there's loans out there that will give you the rehab budget.
So that's where I was going with that.
Yeah, they call it the fix and flip loan. You buy it for maybe 60, the rehab budget maybe 30. We'll give you 100% of the fix up amount, but
You still have to come to the table with something.
To the table because one, if the rehab is 40,000, you still need to have lines of credit somewhere to get the project going because they're not going to just give it to you. They're going to reimburse you is what they're going to basically do. So they're going to, okay, if your first phase is 10, then you show them that you have it done. They come and inspect, they give you 10 back. And you keep doing it that way for the fix and flip. And I always ask what the exit strategy is. If it's on the fix and flip,
again.
The exit strategy.
Say it one more time because I
strategy.
think a lot of when I talk to brand new investors, they know about getting in,
Right.
but they don't have an exit strategy. I talked to one young lady the other day, and her whole thing was because it's glorified right now, right? I want to get in and I want to do this. I want to do. What's your plan to get out?
Right.
Yeah, but I want to do this. I want to do this. But what's your plan? Like, how much do you plan on making on the back end of this thing? Because that's going to tell me where we should start looking on the front end because you're going to make the money. Anyway, go ahead.
Yeah. So
the exit strategy.
So which means that, the lenders, we always ask, what's your exit strategy? I'm going to fix it and flip it. I'm going to buy and hold. So which means if you're going to buy and hold, we got the two loans, that you can kind of get into it, fix it, flip it up. And then my exit strategy, I'm going to refinance into a debt service coverage ratio loan, meaning that we look at the property rent. That's all we look at is the rent of the property. So if your rent, and they look at when the appraisal come and do it, the average rent for the area. If the average rent for the area is $1,500, you should be collecting $1,500 or more. So if your rent is $1,500 and you're collecting $2,000, that's a good loan. If your rent is $1,500 and you're collecting $1,600, that's still good because it's $100 more. As long as it's $1 more, that's a good loan. So that's what the debt service coverage ratio loan looks for when you exiting into one of those. You've already fixed it, you fix it up, and now your exit strategy is to refinance out of that short-term loan into the long-term loan.
So just to clarify, so what we're saying is best strategy is fix and flip.
Fix and flip.
So now we got our fix and flip, but now if we must hold it, right, make sure that we're making the money over. I agree with you. I don't think 500. 500 is just enough to get my eyes open, but it's not enough to really do a dance to.
Right, yeah. You can't retire on it.
No, 500. Yeah, that's tough, right? I know.
You can't retire,
I'm about to liquidate some property right now because of that, right? All right. So we fixed it. We flipped it. Now, if we must hold it and it makes sense to make it a rental, what we're saying is we could go into some kind of debt service loan to get out of the short-term loan to make sure we hold it properly.
That is correct.
And now we're back to the same cycle.
Right.
Okay, I just want to make sure I clarified that properly. And then something that you've said before, two things you've said before that I don't think a lot of people catch because you're so soft-spoken sometimes, right? They don't catch is the first part is the product going into it, right? But then you said something to me one time, and I had to go back and had to check my whole life. Like I said, I don't know if I never told you this, right? But you told me we were talking about being a landlord versus a
owner.
financer,
Right.
right? And I had my whole life changed. I had to go back and sit down, and I had like the little question mark over my head, and I really sat down and I thought about it, and I had a Charlie Brown moment. Oof, right?
Right.
Talk about that real quick.
And I was going to say something. So I'm glad you brought that into there. Basically, would you rather be a landlord or the bank? Because if you own the property outright with no mortgage on it, if you own it outright and no mortgage on it, because become the bank. So one could basically, let's say you have a lot of people that don't qualify for properties. You can still finance them. Meaning that if this person got a 400 credit score, but they're a good person and they got at least 2% that they can put down, I'm going to sell them that house. By selling them that house, let's just say the market value of the house is 150. I'm going to sell it to you for 150, and I'm going to come up with an interest rate. I'm going to create a mortgage, come up with an interest rate of, let's just say 7%, because your credit score is low, so 7%. But
that's fair.
It is fair. Yeah. They just good to be a homeowner. Now, the difference between a landlord is that when things break, you get the midnight calls. And all
little
the
Johnny
stuff,
put the G.I. Joe with the condom on it down the toilet and flushed it 15 times. Help.
Oh, definitely. So now you got to get up. People come and expect you. But when you are the bank, you just own or financed it, they're responsible for the maintenance, the taxes, because it's their house. They just purchased it from you. So just think about it. Remember when I said only with a mortgage do we borrow $100,000 and pay them back $400,000 over 30 years? That's what you are when you financing them that way, when you own it outright. So you're going to sell it to them for $150, finance them for over 30 years. You go to a title company, they're going to create a mortgage for over 30
or even
years.
do a balloon if you wanted.
You can do that too, but you don't even have to do that. You know, so you're going to make them commit to bringing at least maybe 1 or 2% to the table for their commitment. Now we go to the title company, we create a mortgage down there. You make them get insurance and all the other stuff, so they have it now, right? So it's their house, because owners take pride into the house and they do a lot better. So just think, if you're doing that, you kept it for 30 years, that's retirement right there, because you're the bank now. And then if you have to take somebody to court,